No. Yes.
Yes.
Sir, may we request Sri Mahabaleshwar, MD CEO, Karnataka Bank and Chairman, Southern India Bank Staff Training College to formally inaugurate this webinar session, first session that we are doing. And we seek your wishes for the continuation of this. Kindly, few words.
Thank you. It would be my pleasure to formally inaugurate this very innovative initiative, which I consider it as a passionate initiative by our teaching faculty. And I'm very happy to note that our own SIBSTC as well as VRDDHI have joined hands to further enhance the knowledge level of the bankers. So this is a welcome initiative, and I am sure that all our banking members, they would make best use of this. Going forward, definitely we will be looking forward many more such sessions which would contribute significantly to enhance our banking knowledge and also to address some of the practical issues as well. Once again, while appreciating this initiative, I wish the college as well as VRDDHI all the very best in all their future endeavors. Thank you, Ananda.
Thank you, sir. Thank you very much.
Thank you very much, sir, for the kind words and nice words. And a great beginning has been made, sir. Thank you very much.
Okay, Rama.
Yes, sir. Sir, I'll invite Lalita.
Yeah.
No, so, good evening to one and all. Now, I invite Lalita Munan to have a brief introduction about the speakers now. Ma'am, over to you. Ma'am, you're in mute.
You're in mute.
Thank you, Rama. Good evening, everyone. So we are all set to be part of the webinar series, Banking Matters. A word about the title. I think it has a pun on the word matters. Banking matters, things related to banking, and banking definitely matters. Banking is very important. So on that note, Banking Matters is this webinar series, which is jointly or a collaborative initiative by Southern India Bank Staff Training College and VRDDHI Consulting and Training Services. Now, a few words about them. We were very happy to listen to the introductory, morale booster given by the top man in Southern India Bank Staff Training College. Now, this is a premier training institute for bankers established way back in 1972 at Coimbatore. Half a century later, it now stands tall with excellent infrastructure and facilities in the city of Bangalore, now all set to be celebrating its golden jubilee. SIBSTC is supported by 16 banks, including public sector, private sector, and regional rural banks. This renowned institute aims at education, training, and development of banking personnel through seminars, regular classes, study courses, conferences, etc., for officials of the member banks. It also focuses on faculty development programs to assure adequate supply of competent trainers. It has undertaken to disseminate information on management know-how through its various publications. The Institute views to harness the expertise available with other institutions and collaborate with centers that have similar objectives. The college is now headed by Sri KSLN Rao as its principal. Today's webinar is an auspicious beginning and a great initiative utilizing the technical and digital possibilities on banking matters. In partnership with VRDDHI Consulting Training Services, these sessions will surely benefit bankers and professionals even in remote areas of the country. A few words about VRDDHI CTS or VRDDHI Consulting and Training Services. This is a partnership firm based out of Kozhikode or Calicut in Kerala. This is promoted by senior bankers and supported by leaders in the banking industry. Founded in 2017, VRDDHI is into offering consulting and training services to various categories of individuals, corporates, MSMEs, and startups. Its key areas cover project consultancy, preparation of DPRs, assessment of banking facilities, mentoring of MSME and startups, and also offering online live sessions for bankers aspiring to clear JAIIB and CAIIB exams. The response and acceptance of these virtual sessions countrywide has been very positive and encouraging. Banking Matters is the second webinar series initiated by VRDDHI CTS. The first series was on hand-holding MSMEs. The 11 sessions that have gone by, addressed by special speakers and professionals from the industry on various important and very vital topics relevant to MSME, happen to be very meaningful and purposeful, especially in the time of the pandemic. Banking Matters is a collaborative effort by SIBSTC and VRDDHI CTS, and this is certainly going to address many vital aspects of banking at a time when we need to understand in depth the scenario of modern economy and banking. So, friends, it's all set to probably kickstart the whole process. Good evening and welcome to you all.
Thank you, ma'am. Thank you for your warm welcome. Now I request Mr. Ajin K. Anand, Managing Partner, to take over. Over to you.
Yeah, am I audible? Yeah. Good evening all. It's a great evening. Thank you, Mahabaleshwar sir, showing your being present here and addressing us and motivating us. It's a pleasure to be welcoming you all to this webinar series on banking matters, jointly hosted by SIBSTC and VRDDHI Consultancy. The motivation to organize such a webinar is to reach out to as many bankers across cities, towns, and remote areas with the help of technology. This is certainly a digital era, and lots of transformations are happening in the banking and financial sector at a very, very fast pace than before. The changes that's happening are so fast. The relationships are changing, the business models are changing, competitions are giving place to collaborations. We are seeing lots of development in this sector, especially with the coming of technology being done by startups and fintechs. So these innovations are changing the banking atmosphere, giving it a new name and new dimension, and catering to the customer requirements. The need of the hour is to remain updated and abreast of all the latest developments happening in these sectors. Our intention is to present and discuss the most relevant and vital developments in banking industry. We shall be choosing the best from the field to address the participants. We hope that the Banking Matters webinar series will evolve into a much sought after event that banking fraternity will look forward to. With the guidance and support of SIBSTC, the faculty, and all the senior bankers here who are also present here, we hope, we are sure, and there's no doubt that our aim will achieve and it will be possible. Now let me enter my duty of formally welcoming you all. I welcome you, Mahabaleshwar sir, MD and CEO of Canara Bank, for being with us and honoring us with your presence. And on behalf of Team VRDDHI CTS, our faculty and SIBTC, I extend a warm welcome to Mr. KSLN Rao, Principal SIBSTC, our motivator for this evening. I am greatly obliged to him for taking the initiative to organize this event jointly. Welcome to you, sir.
Thank you, sir.
I also take pleasure in welcoming Mr. H Krishnadas, former General Manager, IDBI, who will be making the theme presentation, because we are going to talk on two important topics today. I also welcome the keynote speaker, Mr. G. Rajkumar, former General Manager of Punjab National Bank, and Mr. Vinay K. Bhat, former General Manager of Canara Bank, who will be making the very important keynote addresses. All the speakers are good friends and moral boosters of our VRDDHI and the banking fraternity. Let me thank you too for accepting our invitation. I am also happy to welcome all the participants. I am really happy to see that when the webinars are flooded and we find it difficult to get people to attend the webinar. Now we have almost 66 participants now attending the webinar. That shows the interest the banking fraternity have on this initiative and how they are going to accept it. We will not fail. We will take this forward and we will better. I am sure that it is going to be a worthy evening for all of you, well spent. Thank you all very much.
Yes, sir. Thank you, sir.
Thank you.
And now I would like to take an opportunity to introduce our chief guest, Mr. KSLN Rao, Principal SIBSTC, Bangalore. He has been working in the college since March 2010 and has 31 years of service in Canara Bank. His areas of specialization include high-value corporate lending projects and infrastructure lending, credit policy and risk management, Basel guidelines, international business, ALM, etc. He is also visiting faculty of IIM Bangalore and a couple of MBA colleges in Bangalore. A lot of innovative and training strategies has been introduced by Mr. Rao. He handles plenty of sessions for the top executives and in a great motivator. He believes in teamwork and he is a classical example of a great leader. It is our privilege that he has agreed to enter a tie-up with VRDDHI CTS to host the webinar series, Banking Matters. So over to you, sir. Mr. KSLN Rao.
Thank you, madam. And thank our chairman for allowing us to host this webinar. Thank you very much. And I wish the best of luck. But then as initially, Madam Lalita has said that banking matters. In fact, it really matters. A few words about that. Post-economic reforms of 1991, modern India has been born. From a stage where India was considered as a snake charmer nation to a stage where we are now one of the fastest growing economies of the world, as also one of the most technologically advanced nations of the world. From a stage where India was almost ranked 225th in the world in terms of economic size, today we are the 5th largest economy of the world. So there is a big scope. Already IMF in the recent publications of April 2022 has hinted and also has made a projection that by 2030, India will overtake Japan to be the 3rd largest economy of the world. Today, friends, Indian GDP size is $3 trillion, 3.05 trillion US dollar. IMF has estimated that it may reach to $9 trillion by 2030, which means Indian GDP is expected to grow 3 times the present size. Now, the relationship between economy and banking. We are all aware that economy and banking are like 2 sides of the same coin. Now, there is again an economic relationship or an assumption, which means if the GDP grows by a certain percentage point, the banking also would grow 2 to 2.5 times of the GDP growth. Now, it is expected in the next 8 years, the GDP is expected to multiply by 3 times. That is from 3 trillion to 9 trillion US dollar. Now, with the same economic equation and formula, banking today, Indian banking system is the 14th largest in the world, and it is expected to become the 3rd largest by 2030. In terms of business, as I said, the relationship between the economy and banking, if the economy is expected to grow by 3 times, therefore, it is minimum that the banks are expected to grow by 5 times the size what they have now, which means whatever is the size as of March 2022, we should be doing a business of 5 times than that. In fact, Indian banking system has a business size of around 230 lakh crore rupees. It is expected that Indian banking system will be doing a business of around 1,000 lakh crore. So when the business is bound to grow, obviously the risk elements or various aspects will have to be seen. The business growth would always mean that it shall be a qualitative business growth. When quality is the essence of the growth of business, we need to focus how to enhance the quality, and in case there are any aberrations in between, how to tackle all those things to ensure the growth is qualitative. In that direction, these kinds of seminars are organized, particularly the two topics of today are very relevant. One, to ensure qualitative growth, and number two, to ensure retention and maintenance of qualitative growth. So therefore, like this, in the months to come by, we shall organize these kinds of and also the relevant topics for the webinar sessions, which would enable our bankers to enhance their knowledge and also to be on par with the development that are happening both in economy and in banking. Thank you, Mr. Ajayan. Thank you, one and all. And our grateful thanks to our chairman, Shri Mahabaleshwar, for allowing us to do this. Thank you very much. And let the sessions begin now without much waste of time. Thank you, one and all.
Thank you, sir. Now I invite Mr. H Krishnadas, former General Manager of IDBI Bank. Mr. Krishnadas began his banking career with Indian Banking in 1983 as a probationary officer. He has working in various capacities all over India as a branch head, cluster head, regional head, general manager, and senior regional head across AP, Tamil Nadu, and Kerala. He was guest faculty at Banking's Training Center in Chennai, Bangalore, and JNIFBF at Hyderabad and some of the institutes. He was among the few selected by the bank to attend a special Euro Money Retail Banking Program in Singapore in May 2010. Attended Advanced Management and Leadership Program in Bocconi Management Institute in Milan, Italy, and ESCP Management Institute in Berlin and Paris in 2014. So I invite Mr. Krishnadas to give a theme presentation.
Thank you. At the outset, let me thank SIBSTC and Pradeep for giving me this opportunity. It is such a proud privilege to be here on this day, on this evening, to present the two topics that are being introduced by two eminent bankers, very seasoned bankers, Sri Rajkumar, a former General Manager of Punjab National Bank, and Sri V.M. Bhat, a former General Manager of Canara Bank. Mr. Rajkumar will address the participants on the theme of bad bank and appraisal. Can it be successful with a government subsidized, subordinated guarantee? And the second part of the session will be addressed by Sri V.M. Bhat. He will be talking on the Insolvency and Bankruptcy Code 2016, an overview including pre-packaged IP for MSMEs. I will just have a brief on these two topics, and then we'll hand it over to Mr. Rajkumar for the first session. As all of you know, a solid banking system is one of the prerequisites for any developed economy. Mr. Rao was mentioning this. And one of the challenges that we pose for the system is the stressed assets. So these stressed assets create a formidable challenge for the banking system as of now. A high level of NPAs will always point towards a high probability of credit default. We have seen this. We have been going through this. We still continue to face this challenge. What happens when a considerable amount of stress in an existing credit scenario, when it persists, it will reduce further availability of credit that we have seen, and it becomes a very serious problem for the lenders as well as the policy makers. This is one of the challenges that we face now. And large unresolved NPLs, the non-performing loans, over a sustained period will apply a sudden brake on the economic growth also. So, building up NPAs or a scenario where NPLs are growing will be totally unwarranted or totally on a negative side when we think about economic growth. So, and on top of it, we have had a pandemic, the likelihood of further issues and the impact of COVID-19 on these sectors, that is also a matter of concern as far as non-performing assets are concerned. The relevance of bad bank, it gains prominence in this particular context, in the context of growing NPAs, in the context of, preparing oneself, our economy for galloping in terms of growth. So this is the relevance of bad bank comes into prominence in that particular context. And we should also, perhaps the gross NPA levels have crossed 10 lakh crores. It perhaps crossed, I don't have the exact figure, but it has perhaps crossed 10 lakh crores. The proposal for setting up a bad bank, was first mooted again by Indian Banks Association, and was submitted to a report was submitted to RBI based on a panel recommendation, and that to Mr. Sunil Mehta from Punjab National Bank. He was heading that panel, and that is the genesis of the bad bank, which later on was examined by RBI. So today, it is a proud privilege for VRDDHI to have another eminent speaker from the same bank, from the same Punjab National Bank, to talk about bad bank and appraisal on the same. The advantages and disadvantages of bad bank have been subjected to continuous debate. There were serious discussions on this. And the point of contention was basically on the capitalization of bad bank by government, or capitalization of the bad bank by participating members, or capitalization through private and public sector enterprises. So can it not work successfully with a government subordinated guarantee? That is that is something which all of you will, with Mr. Rajkumar, will walk you through on all this in his first presentation. Coming to the second one by Sri Bhat, the Insolvency and Bankruptcy Code, which was of 2016. This code establishes a very, very comprehensive set of guidelines for timely resolution, and basically deals with insolvency and bankruptcy of corporates, of LLPs, of individuals, of partnerships, and also sole proprietorship concerns. Unfortunately, MSME doesn't come in that categorization. Of course, MSME gets classified in one of these, which are mentioned. It is not separately considered. Okay. For any bank or lender, you all know, the possibility of not receiving a timely repayment of a contracted amount, or the counterparty to a contract not meeting its obligations, this generates considerable risk for the lender. Okay, so this risk is being addressed, or it has to be addressed by the lender by maintaining adequate capital. That is one way, and also making very optimal provisions in terms of such losses. So that is the main aspect in terms of mitigating this risk of non-payment. The inability of business entities to pay creditors, that can be on account of basically two. One is inadequate cash flows, I don't have to mention that. The second one is the market value of the assets that they have falls below the value of its liabilities as far as a firm or an entity is concerned. So that is a scenario under which an entity becomes insolvent, and the inability of the borrower to repay will definitely reduce the value of assets of the lender. Okay, it has a direct impact that way. And that will also, in a way, impact the lender's capability to repay its depositors, depending on the seriousness of the situation and the number of such defaults that we have. We have seen this happening not only in our country, but in other countries as well. So that is on the insolvency resolution part. Once a borrower becomes insolvent, the natural instinct of every lender will be to catch hold of the biggest pie in the marketable assets of the borrower. That is quite natural. We want to make ourselves very safe. We want to make ourselves, take off whatever that is available in terms of, realizable assets. But what happens in a scenario? In such a scenario, in most of the scenarios, especially in the case of MSMEs, the borrower, may have an existence, still he can exist, the business can continue, but the lenders do not look at a scenario where, where it can go on, or that part of the management part gets very little attention at that point of time. Because the moment you see that there is an issue in terms of the solvency of the firm, you tend to make every effort to get whatever that is available from the assets of the borrower. So that is a natural instinct of lenders. And depending on some of the depending on the level of stress of some of these cases, the lenders or the creditors can also adopt a strategy of a delicate balancing of debt, whereby you give necessary inputs to the entity to survive and move on. So this is one area which needs to be looked at in a much more focused way in terms of resolution of NPLs. And the resolution of NPLs as an ongoing NPLs cases on an ongoing basis, on an ongoing business basis, will add more value to the lender than a liquidated one, because all of us know that a case where it can move on with business has better probability of giving returns. So the resolution process will primarily hinge on the going concern concept, and the creditors in such cases to handhold each other, to work out a strategy to see that the entity goes on with its business. And at the same time, the effort will be to arrest the deterioration in value of assets that are charged. Then identifying transactions, probably the transactions done by the entity which possibly created a stress. So that and clawing back such transactions. So that could also be one way of looking at it. So this is in brief, the way we look at the second part of the session. And I'm sure Mr. V.M. Bhat will throw more light on this to all of you in the second part of the session. So with that, let me conclude. And thank you very much once again, VRDDHI and SIBSTC, for giving me these opportunities to present the topics for today. Thank you.
Thank you, sir. Thank you. Now, I would like to take an opportunity to welcome Mr. G. Rajkumar, sir. Former General Manager, Punjab National Bank. General Manager, Credit PNB CEO, Punjab National Bank, Dubai. Advisor, Technical to PTC Finance Services. Board member of CIBIL and Indian Adventure Fund of ICICI Bank. Has 40 years experience with specialization in credit, forex, treasury, balance sheet recovery. 2 international award winner, Asia Leadership Award, and from Institute of Economic Studies, Delhi. Sir, over to you, sir. I invite you for the session. Over to you, sir.
Thank you, SIBSTC, VRDDHI, Mr. Krishnadas also for explaining in brief about the topics which are going to be taught. So my job is made a little easy by Mr. Krishnadas. The topic is bad bank, whether a subordinated government guarantee can find a better solution for Indian situation. Before commencing the subject, I would like to say there was a news through the budget that India is going to start the first bad bank in the country. But to me, I feel there is no much difference between bad bank and ARC. Bad bank, there is no clear definition for both these things. In the West, it is known as bad bank. They have reasoned it for housing the bad assets of the bank. In India, it is known as asset reconstruction company based on its function of restructuring. So basically, both are same. But in India, when it is introduced through the budget as a big brother, probably some additional features are there, like government guarantee and sponsorship by the public sector and private sector bank, like that. Previously, all the ARCs were under the private sector. So that way, both are more or less the same only. What is the function of a bad bank or ARC? See, it is a third-party organization to which the bad assets of the bank are transferred at a price, a negotiated price, with a function to them to realize maximum out of it through revival or selling of the assets. And as a compensation for this transfer, they issue 15% upfront cash plus balance 85% in the form of security receipt, which is nothing but a bond, redeemable bond, redeemable over a period of 5 + 3, 8 years. This is basically the function. Now I am going to explain this in the following format. One is briefly, because time constraint is there, genesis of NPA, genesis of recovery mechanism in Indian banks or all the banks, ARC functioning, the advantage and disadvantage of that, the problem for the banks, the sufficiency of the government guarantee introduced in September 21, a prescription of a German model where the guarantee is a subordinated one. That means government is not going to bear the loss, but it is creating a structure like that. Now, genesis of NPA. See, the main income of a bank, as everybody knows, it is interest on advances. Banks get this interest on advances, and this is utilized for payment of interest to depositors. Naturally, interest payment from the advance is a very basic necessity for the survival of a bank. The differential between the income, between the interest income and interest expenditure, adjusted for the establishment expenditure, is the profit of the bank. Naturally, NPA is, for the purpose of this discussion, we need not go into the deep definition of that. NPA is that account which is not servicing its interest or repayment of principal or remain irregular for a continuous period of 90 days or more. Naturally, the bank will not be getting interest which is required for making payment to the depositors. Hence, we can briefly say that NPA is a matter affecting the stability of the banking system and bank or the economic situation of the country as a whole. A bank makes an assessment at the time of granting loan. It makes an assessment about the repayment capacity of any borrower. It is based on the projected cash flow, which is assessed at the time of sanction of the loan. However, it is possible that in reality, in some cases, the actual cash flow may be lesser than the projected cash flow, which can lead to default. Some of these defaults or cash flow mismatches may be of temporary nature, and some are of long-term nature. That cash flow mismatches which are of long-term nature are slipping into NPA. This NPA can be on account of external matters as well as internal matters. External means it is beyond the control of the promoters, that is, policy change by the government, obsolete, the product becoming obsolete, or it can be out of competition. Internal factors are incompetent management, diversion of funds, or it can also be due to willful default. Now, let us come to the genesis of recovery mechanism in banks. Generally, in all banks, there is a recovery mechanism of its own. Through the branch, regional office, sub office, head office, they are having their own department and they will be monitoring the accounts and recovery efforts will be made. Once an account becomes NPA, they will resort to recovery measures by recalling the account and resort to recovery measures such as referring to adalats, action under SARFAESI Act, one-time settlement, suit filing, or referring to NCLT since 2016. When the number of NPA accounts have increased, it was felt necessary that instead of all the branches following the recovery measures, banks have started incorporating specialized branches for the purpose of recovery. Almost all the banks in India are having separate specialized recovery branches. They will be manned with the legal and the technical experts, and they will be doing only the function of recovery. Subsequently, when the NPA level has gone beyond a certain level, maybe 10% or something, bankers felt that their performance is getting affected, their image is getting affected. So the next step, like removing these bad assets from the balance sheet of the bank, was thought of. That way, the purpose was to clean the balance sheet by transferring these assets to a third party who will do the recovery efforts on behalf of the bank. But this is for the purpose of removing from the balance sheet. A selling transaction is taking place. Bank will be making an assessment about realistic value and it will be sold to them. So here comes the role of ARC or a bad bank. Now let us see what is the function of an ARC. The function of an ARC starts once it houses the bad assets of a bank. The assets, as I told earlier, the assets are purchased by ARC at a negotiated realizable value. In India, it is done at a realizable value. In return for an upfront cash payment of 15% and balance by way of security receipt redeemable over 5 + 3 years. By acquiring these assets, the bad bank steps into the shoes of the bank as far as rights and obligations are concerned. So it is having all the rights of a bank for doing anything with the bad assets. Primary function is the maximum amount. The options available to the bad bank, or the expectation from the bad bank is that first of all, they should try for revival of the unit. Revival of the unit means it can be done through takeover or change of management, turn it around, recover the full amount, then give it back to the management. That way, an economic asset of the country is maintained, the labor is preserved, so a value is not lost in the economy. That unit is running and it is turned around and it is given back to the promoters. Second option available is rescheduling or restructuring of the existing loan terms. See, the main reason for default is such that it is because of the lower cash flow of the borrower. So according to the available cash flow, it is not a debt institution. It is not a debt unit at all. Their cash flow, instead of 1,000 crore cash flow, they may be getting only 500. So according to their cash flow, restructure the loan terms in such a way that some temporary relief is given to the institution by way of reducing the interest rate or by extending the tenor of the loan, by installment will be reduced and tenor will be increased, some waiver of overdue interest or things like that. These are the methods. If both these are not successful, means revival is not possible. Then the option available to them is to sell these assets by aggregating from all other banks. Generally, all big advances are under consortium, and consortium decision taking at each branch level will be difficult. So they acquire all these assets from various banks, and as a single owner, they aggregate all these assets and get a better bargaining power in the secondary market for the industrial assets. So the advantage for the banks, if it is transferred to ARC, a third party, is bank can clean its balance sheet by removing toxic asset from its books. It enables better credit rating of the bank and a better terms for raising funds in future from investors. The capital released from high-risk weighted assets, plus the upfront cash received and realization received in due course of time, can be used for giving fresh advances, earning interest. In the previous situation where capital is locked up and interest is not received, bank could not lend further. Many banks have reached that kind of a stage. So this is a release of capital and enabler for further disbursement. Saving of manpower for recovery and better concentration on the core banking function. Now let us see what are all the discomforts or the disadvantages of the bank. See, from the practice hitherto, we have understood that the prices offered by ARCs are based on the book value. It is very much less. They are asking for too much of discount. Banks had total discomfort on that, and that is one of the reasons why delay is happening in selling it out. Secondly, in between some call has happened. Secondly, there is a need for giving provision on the security receipt issued based on the net asset value. In some cases, when full redemption is not taking place, a write-off also has been made. So these are the discomforts of the banks, and there is a little bit of mistrust between the bank and the ARCs. Here comes what is RBI's role. What is RBI's role? In between some call is coming that. RBI is the regulator for both bad banks as well as for the ARCs, though it is under two different acts. One bank is controlled under Banking Regulations Act, and ARC is controlled through SARFAESI Act. RBI has to ensure a fair price for its assets to the bank and a fair return for the investments made by the ARCs. So they have to understand the problems of both. Since it is a new concept, they have to keep on evolving the system and structure so that both a conducive atmosphere is created. With this purpose, RBI has appointed a committee in 2021 to review the performance of the ARCs and submit its recommendation. That recommendation has been submitted by the committee in September 21. Some of the observations the performance of ARCs are lackluster, both revival and recovery. Average discount rate at which assets were purchased are at 66%, means acquired at 34% of the book value. It further declines by another 15%. This has happened during 2003 to 14, which was the period through which they have made the analysis. It has further declined by 15% during 13-21, when the minimum investment in SR by ARC has been increased from 5% to 15%. Next important thing is only 14.29% of the book value has been realized through ARCs. That is, if 100 crore worth of assets NPA is there in the books of the bank, only 14 crore has been realized through ARCs. The rest is a loss for the bank. Out of this realization, about 80% of the recovery is through sale. That means only 20% has been revived. And that revival of 20% is also only small units, not any big corporates. Out of total SR issued, 68% of the SRs were redeemed. Balance 31.4% of SRs were written off by the banks after 8 years. This is a very poor state of affairs. In this background, RBI has made a lot of recommendations, but two important recommendations I will tell here. One is that RBI has to give a special dispensation to banks to amortize the loss on transfer to ARC over 2 years. Now, presently, it is to be booked in the year of transfer. This was a major hurdle for banks in selling, because immediately booking the entire loss in the books on the same year has been a major hurdle for the banks. So RBI's committee suggested to make it in 2 years. Secondly, they observed that the reason for poor performance of ARCs are very much delayed transfer of assets by banks to ARC. That is, after becoming NPA, it is waiting for recovery by itself, fearing so many things. And by the time they transfer, the unit must have become dead or the value has come down. So this is one of the reasons for poor realization. So they suggested that even SMA account also can be transferred to the ARC. So these are the two main recommendations which they have made. They have made a lot of fun. Now, we will come to the real subjects which we have to discuss. So through the budget, the finance minister announced introduction of Bad Bank with government guarantee. RBI granted the license for the first bad bank in India, nomenclatured as a bad bank. There is no much difference, but still, since they are referring it as bad bank, it's okay. The main difference is that the sponsors are the PSBs with the 51% share and private sector banks for the remaining. This bad bank is NARCL, National Asset Reconstruction Company Limited. This has started with an initial NOI of net own funds of 6,000 crore, and a government guarantee of 30,600 crore with a purpose of acquiring 90,000 crore worth of identified NPA in 38 accounts. The total is 2 lakh crore, but in the first phase, they will be accepting 90,000 crore out of 38 accounts. Only 500 crore and above accounts are considered for this purpose. Government guarantee is for the full redemption of SR. Means hitherto the situation was that if the redemption of SR has been non-obligatory, and in many cases it is not fully redeemed and it has been written off by the banks, and unredeemed portion has been written off by the banks. Now government is giving a guarantee that if the realization is lesser than the SR, then this government guarantee will be available. I think here it is a primary guarantee by the government. But government is having a separate structure here. They have, along with the NARCL, they have also incorporated another Indian Debt Resolution Company Limited, IDRCL, which is a service company to manage the assets for realization through professional and turnaround experts. Through this establishment, government expects that the realization can be more than what we have seen in history. So there may not be much case of invocation of guarantee. This is the expectation of the government. But if by chance, now it is started, we have to see the result. If by chance, if the realization is lesser than the SR value, the government guarantee can be invoked, and it can it will be a problem for the economy. Means the government taxpayers' money is being utilized. All those interpretations can come. Last week, the market was a little surprised when this NARCL has offered to IOB a value of 8%. So everybody was surprised why NARCL is giving, because the complaint against the private ARCs were that they are asking for deep discount. NARCL also has offered at a very deep discount. So again, the bank's concern is not getting addressed now for this with this first deal. In future, how it will be coming, we have to see. Probably we do not know the background of this asset. Probably it must have been very aged asset or obsolete asset. That is also possible. That kind of information is not available in the news site. Now, let us come to the caption item. I am referring about the German model of subordinated government guarantee. See, Germany has evolved a system whereby an SPV will be created as a bad bank by each banking having substantial NPA. Instead of we forming a third-party organization totally different from the bank, they are making each bank having a additional substantial amount of NPA has to create a SPV for themselves. They will not deal with any other bank's assets. The prescription is that the transfer is to be made at not less than 90% of the book value of the asset. That means only 10% they have to book in the place where in India, if it is purchased at 80%, 20%, 80% is to be booked. Of course, provision, if it is already made, to that extent, it will be less. SPV has to issue bonds at transfer price, duly guaranteed by a government fund, specially created for this purpose under Stabilization Act 2008. That fund is called SOFI. This government guarantee ensures third-party investment, tradability, liquidity for the investors. This is a good point. It is a credit enhancer. This guarantee is a credit enhancer. Though this is sold or transferred at 90% of the value, simultaneously, a realistic value of this asset is also assessed through an independent valuer. Suppose a 100 crore book value asset is sold at 90 crore and the realistic value is found at 20 crore. The difference is 70 crore. This difference between the transfer value and the realizable value assessed by the independent valuer is to be paid by the bank over 20 years period in yearly installments to the SPV. This is the structure they have made. Ultimately, the government has made it very clear that we will not bear any loss because of the poor functioning of the bank. That is how they have made it a subordinated guarantee. Government has only created a structure which enhances credit in the market or for the tradability of the bonds. They have made it very clear that we will not use taxpayers' money. So that way, banks are protected by deferring the losses over so many years. Government guarantee enables trading and in the security, there is investor is coming into the picture. So ultimately, if by chance, if the realization is lesser than this bonds value, that also is to be compensated by the bank. So ultimately, the entire loss is to be borne by the bank, but they are being borne by the bank over a period of 20 years. This is the greatest comfort, and the structure is successful. And this SPV, which is specifically created by each bank, will be wound up after realization of the assets. This is the structure they have made. I feel India also can think about this structure, which do not fall back upon the government guarantee. Banks are given special, the only thing is RBI has to consider a special dispensation for the banks to adjust the loss over a period of 10 or 15 or 20 years. So this is the successful German platform which can be thought of by the RBI and the government also. So thank you very much for the person listening. Thank you very much. If anybody is having any questions, they can ask.
Rajkumar sir, we can have a discussions after the next session. So we can have a discussion. Can you hear me? Am I audible?
Good evening, Ajay sir. Good evening.
Am I audible?
Yes, sir. Yes, sir. Good evening.
Yes, you are audible. Please continue.
Yeah. Sir, what we feel is that we can have a discussion after the next keynote address also, so that both the discussions can be taken at that point of time. That is my suggestion. Can we take it forward? Hello. Can we proceed like that, or should we have interaction now itself?
Ajay sir, good evening. Am I audible?
Yeah, sir. Please.
Okay.
So what I suggest is that whether we can have in the interaction after this.
Yeah, your suggestion is okay. We will have the interaction at the end.
Okay. Can I ask Dr. Lalita Menon to introduce the next guest?
Yes.
Yeah. Yes, please.
So we now go over to the second keynote address, the title Insolvency and Bankruptcy Code 2016, an overview including pre-packaged IP for MSMEs. Our speaker for the day, for the second session is Mr. Vinayak M. Bhat, former General Manager, Syndicate Bank. Mr. V.M. Bhat held various positions in the bank and worked all over India. He was also General Manager in charge of Special Monitoring Accounts Department, Corporate Office, Bangalore, Special Advisor of NPA Management and Legal Departments of the bank. Mr. Bhat was also faculty at Syndicate Institute of Bank Management for 4 years and is now working as senior faculty, Southern India Bank Staff Training College, Bangalore. He is a relentless learner and holds various degrees and certifications, including IBC 2016, conducted by Insolvency and Bankruptcy Board of India, and also resolution of stressed accounts with special focus on IBC 2016, conducted by IIBF Mumbai. So now it's over to you, Mr. Vinayak M. Bhat.
Vinayak sir,
Yeah.
I think before you start, Sri Krishna sir, you are there?
Yeah, I am there.
Thank you, sir. We have started the session. We miss you in between. Okay, sir. Thank you, sir.
Ajayan, can I proceed?
Yeah, please. Yeah.
Good evening to all of you. My special thanks to chairman of our institute, Sri Mahabaleshwar ji, also my principal, Sri Rao sir, and also Ajayan. I would like to start straight away. When I say Insolvency and Bankruptcy Code, bankers only view it as a tool for resolution of their NPAs. In fact, the purpose, objective of introducing IBC in 2016 was not simply resolution of asset. There were some many more purpose. Now, anyway, let me start my session with what is the stressed asset in our industry, banking industry. The details I have presented before you. The 2022, the gross NPA figure is 5.97%. In reality, a stressed asset means the NPA plus restructured advance plus SMA2. Restructured advance also because of stress you have restructured. And SMA2 almost nearing NPA, they are also stressed. So together, friends, if you look at the whole situation as a stressed asset in the industry, it may be more than 12%. So 12% is not a favorable figure. So we need to handle stressed asset very strongly. Now, stress is created in an account maybe because of external reason or internal reason. The stress gets expressed in a loan account by way of default or insolvency. Also, there are many other early warning signals which indicate stress in the account. So I would like to clarify one important word, that insolvency. What is insolvency and what is bankruptcy? Insolvency and bankruptcy are two different words. Insolvency means an inability of a borrower to pay. A position status where borrower is not in a position to pay is legal dues. Whereas the bankruptcy is legal declaration of insolvency. When it goes to court or when it goes to MCLT, they declare, as you are not able to pay, when they declare insolvency, then it becomes bankruptcy. So they are two different words. Then I will move to the next part of my session, that is how to deal with stressed asset. What are the different ways of dealing with the stressed asset? RBI is very clearly told that the stressed asset had to be identified at an early stage, and you have to identify the reason for stress and formulate resolution plan or take corrective action. Corrective action as early as possible. So the early corrective action, the purpose of early corrective action is to preserve the economic value of the asset. Now, for handling stress asset, we required a strong legal framework. Legal framework that will help us in legally addressing the resolution. So the legal framework entered, was introduced in India in 2016 in the form of Insolvency and Bankruptcy Code, to deal with stressed asset. And the IBC deals with insolvency in a time-bound manner. The focus of IBC is resolve first. Don't go for liquidation first. So IBC, in the first place, prescribes resolution and revival of the stressed asset. So suppose in case resolution and revival is not possible, then only the IBC will move for the next stage, that is liquidation. So I told you the objective of introducing IBC was not simply recovery of loan. There were so many other issues in this. Number one, the resolution, then the maximization of value, then the promote entrepreneurship, make the credit available, balance the interest of all stakeholders. So ultimately, the advantages that can accrue to the banking industry, the banking industry as a industry as a whole, that the IBC should improve the ease of doing business, then reduce the time taken for liquidation, reduce the cost of liquidation, improve the recovery rate, and also enable voluntary liquidation. Suppose someone wants to exit from an industry or a business, the IBC provides for voluntary liquidation also. Now, for smooth implementation of Insolvency and Bankruptcy Code, the Act created 4 pillars. One is Adjudicating Authority, IBBI Insolvency and Bankruptcy Code of India, and the third pillar is Insolvency Professional Agency, and the fourth pillar is Information Utility. I am going a little fast because a lot of things are to be told within the time available to me. I want to convey as much as possible. That is my purpose. So when I say adjudicating authority, the main pillar of the IBC, adjudicating authority is the NCLT, then NCALT, then Supreme Court. NCLT, NCALT, then Supreme Court in case of companies and LLPs. In case of individuals and partnership, it is DRT, DRAT, and Supreme Court. These are the 2 tier adjudicating authority. Then IBBI, this is like a regulator. It is a regulator for IBC implementation. Then Insolvency Professional Agency. These are the agencies which develop what are called insolvency professionals. They register and train insolvency professionals who are very important pillar in implementation of IBC. Then lastly, information utility. Information utility is nothing but the electronic database. All cases refer to IBC, whole information including the default position will be available in this electronic database, that is information. So this is the 4 pillars created for IBC 2016. Then what is the fundamental principle? Now, before that, I would like to tell you, the government has notified the resolution, insolvency resolution for only corporates, that is companies and LLPs. So I will talk only about a corporate insolvency resolution process. So I will deal only with companies and LLPs. So what is the fundamental principle behind this corporate insolvency resolution process? Insolvency resolution in case of companies and LLPs. So the fundamental principle is till it is admitted in IBC, till it is admitted in IBC, debtor will be in full control of his business. Once it gets admitted to IBC, once it get admitted under IBC for insolvency process, the whole control of a unit, enterprise, an industry will be shifted to creditor, not the debtor. Debtor has to walk out. Please remember, the promoter, the board has to walk out of the company, and the company management will be taken over by the representative of the creditor. Who is the representative? Who is called resolution professional. So this is very basic issue that you have to understand. Once any case is moved to, any loan account is moved to IBC, the debtor loses control of the unit and creditor takes control of the unit. That is the fundamental principle of corporate insolvency process. The corporate insolvency process, I again repeat, why I call corporate insolvency process, because presently only companies and the LLPs are under IBC 2006, which are notified by Government of India. Individuals and partnership are not covered. They are not notified for resolution. So the resolution involves two steps. Step 1, resolution. Step 2, liquidation. The resolution of a stress, the first phase is resolution of stress. Start with admission. So let me quickly go through the flow chart, how the process moves. Let me tell you in very simple words. Whenever the company, a corporate, a company or LLP defaults, please remember default, I said default, even 1 day default, that is SMA 0, I can proceed with IBC. Account need not be NPA. Please remember this. For proceeding under IBC 2016, account need not be NPA. Even at SMA 0 level, 1 day default, I can proceed with IBC. So one more condition is, one is default condition, another is default of 1 crore and above. Earlier it was 1 lakh. Now after COVID, it has been increased to 1 crore. So to proceed with IBC 2016, there should be a default of 1 crore. And then only I can move forward. Who can proceed to IBC under this IBC 2016? Who can start, who can initiate the process? There are 3 people who can initiate the IBC process, go against the company. One is financial creditor, that is banker. Another is operational creditor. Operational creditors are those who are engaged in supplies, provision of services and supplies to the company, including the government. And the corporate debtor, the debtor himself can approach for insolvency resolution. So suppose a bank has a company loan which has defaulted. Default has occurred, and default occurred with the minimum default is 1 crore. Then bank can move to NCLT. The first level of initiation. The first level of initiation is NCLT. Now, when a banker goes to NCLT, he needs to have 4 things in his hand. What are the 4 things? 1, application in prescribed format. 2, 25,000 fee. 3, name of the resolution professional. And the 4 is evidence for default. So with these 4 things, I will approach NCLT. When I approach, NCLT may admit or may not admit. When NCLT will admit, suppose default has really occurred, default of 1 crore and above has occurred, and it is a company or LLP. Suppose all these conditions are satisfied, then only NCLT will admit the case against the company for insolvency resolution. Now, suppose it is not satisfied, it will reject. Rejection or acceptance should be conveyed within 14 days. So within 14 days, the NCLT will admit or reject. Once it is admitted, it will appoint one person who is called insolvency resolution professional. He is in fact the empaneled professional in the with any of the insolvency professional agency. He has some qualifications like senior advocate, 15 years senior advocate, 15 years management banker, then 15 years senior chartered accountant. All these have to pass an examination. They can get and enroll themselves with any of the 4 insolvency professional agency, and they can become insolvency professionals. Now, once it is admitted in NCLT, then the 3 things happen. One is IRP is appointed. There will be moratorium on any recovery action. And the third important thing is board of the company, the management of the company, that is the board chairman and the board members, they are suspended. Suspended means they cannot get themselves associated with the company. They can only attend the meeting, that's all. Otherwise, they have no say. Now, the IRP will make a public announcement. He will call for claims from all the people, operational creditors as well as financial creditors. Then he will collect the claims. Then he will find out who are all financial creditors, who are all bankers. Then he will constitute what is called COC, Committee of Creditors. He will form Committee of Creditors. Then the IRP will hold the meeting of first meeting of COC. Then his name will be approved. Then he will become resolution professional. Then the job of COC, that is COC is Committee of Financial Creditors. Committee of Creditors, Financial Creditor. Financial creditor is banks. So they form the committee, and this committee will take over the management. Our resolution professional as a leader, he is in charge of entire affairs of the company, because the actual management, actual board of the company gets suspended. In his place, resolution professional acts as the chief of the company. He will be in charge of managing the affairs of the company. His duty to ensure that the company continues at an ongoing concern. So then the most important part of the resolution, insolvency resolution process is what is called the preparation of resolution plan. I told you that because of some stress, there is a default. And what is the reason for stress? The committee of creditor as well as RP should sit together and find out the ways of resolving the stress in the form of resolution plan. So within 6 months, the RP along with the COC should formulate a resolution plan and approve the same with 66% majority. Now, I will not be covering the full entire details of resolution plan. When resolution plan is prepared, there are certain conditions which are to be satisfied, because the resolution plan should take care of the claims of all creditors, including operational creditors. So there are so many other conditions. I will not get into those details because of shortages time. When once a resolution plan is approved by COC, it will be presented back to NCLT again. NCLT, if satisfied, will approve the resolution plan. If resolution plan is not submitted within the stipulated time of 180 days, that can be extended up to 330 days, then automatically the company will move to liquidation. Please remember, if resolution plan is not submitted within the timeline, then company will move to liquidation. If resolution plan is approved by NCLT, then company will get into resolution mode. So there will be implementation of resolution plan, then company will come out of stress. Once resolution plan is implemented, company will come out of stress. Suppose during the implementation, some problem happens because of non-cooperation, because of wrong planning and all that. Suppose the resolution plan is unsuccessful, then also the company will move to liquidation. Then what is liquidation? Friends, in liquidation, again, it is a new process. Liquidator will be appointed. Liquidator will call for the claims of all, again, the operational creditors, financial creditor claims. He will collate, he will examine the claims. Again, the next process, he will value the firm's, the company's assets. Then he will auction the assets. Then he will keep all the proceeds of auction in one account called estate account of the firm. Then the amount received after the sale of assets of the company, he will distribute in what is called waterfall mechanism. Okay, the waterfall mechanism, under waterfall mechanism, the money received out of the liquidation proceeds, first will be given to the insolvency professional cost, then it will be given to secured creditor and workmen dues for 24 months. Then it will go to the non-workmen, officials of the company. Then suppose something remains, it will go to unsecured creditor. Suppose something remains, then dues of the government. Suppose something remains, the preference shareholders, then equity shareholders. If something remains after distributing all these people, it will, remaining money will go to the promoter. So I will just summarize my discussion. In insolvency resolution of a company, there are two stages, two phases. Phase one, resolution, where resolution professional along with COC come together, work out a resolution plan. So suppose first phase is not successful. Say company is not viable for resolution. Say resolution plan is not successful. Resolution plan is not submitted within the timeline. The company will be moved to second phase, that is liquidation. Please remember, liquidation will end the company's existence. Liquidation of the company will end up in dissolution. Ultimately, RP, the liquidator, will recommend for removal of the company's name from ROC. So that's all about the IBC process. Now, I will move to the next aspect of my discussion, that is 2016 IBC, December 1st IBC was implemented, 2016. Now 5 years are over. whether the objective for which IBC was enacted has been fulfilled during last 5 years. Now I am going to present some data before you. It is up to you to conclude whether the objectives have been achieved or not. Now, how we judge the performance of IBC? The performance of IBC is always judged by actually whether there was real resolution of insolvency, whether value maximization has happened, whether the entrepreneurship is promoted. From these three angles, we are required to judge the performance of the Insolvency and Bankruptcy Code 2016. Now I am presenting chart before you. The latest chart, that is March 2022, is available with me. Now look at this chart. The till March 2022, totally 5,254 are admitted. 54 cases of companies are admitted. Out of that, 3,406 cases are closed and 1,852 accounts are still under ongoing process. Now, this is one information. Next information is, I told you 3,406 cases referred for insolvency resolution to NCLT have been closed. Out of that, 730 have been closed on appeal, review, or settled. 731. And 586 cases have been withdrawn. Withdrawn, settled, withdrawn, they are different issues. Then 1,609 have ended up with liquidation. Now, this is very important information that I am giving you. 1,609 cases have ended up with liquidation. That means 1,619 companies are closed. They have ended up with closure. It means there was no resolution. There was no resolution in case of 1,609 cases. That is 51% of the total accounts cases closed are ended up with liquidation. Then 480 cases, there was approval of resolution plan. That you can say 480 cases, the resolution has happened. Then out of the total, this one, the sector-wise manufacturing sector was highest, followed by real estate. I would like to tell you that in the manufacturing sector, lot of stress is there. And next is real estate sector. The stress in real estate sector also equally high. Then now I come to the another next part. The closed the percentage wise closure. The out of total closed account, 47% went for liquidation. Then appeal 22%, appeal, review, settled, withdrawal 17%. Resolution plan, resolution has happened only in case of 14%. This is as per the latest statistics. Now, the 40% I told you, stressed asset moved to under manufacturing moved to IBC. 20% of real estate sector moved to IBC. Then the liquidation. In liquidation, please note, in liquidation, sorry, %, See, out of the cases moved by the bankers, I'm talking about the bankers. Now focusing on the bank account. See, IBC need not be filed by bank alone. Operational credit also move the case to IBC. But let me focus on cases moved by the bankers to IBC. So out of the cases moved by the bankers, out of the cases closed, 53% end up in liquidation, 20% ended up with resolution, 12% withdrawal, then 15% appeal, review, and etc. Now I will move to the next most important thing, timeline. See, when IBC was started, timeline was most important factor. Every stage they had set up timeline. For admission, 14 days, then appointment of IRP, then constitution of COC, meeting of COC, then resolution plan implementation, then submission to NCLT, then liquidation. Everything was time bound. It should happen in a time bound manner. There, the IBC specified timeline for it. But what happened after 5 years? What is the position after 5 years? 66% of the total cases referred have crossed 270 days. And the reasonable period was 180 days only. Now, 9% have crossed 180 days and within 270 days. 12% have crossed 90 days, between 180 days, 90 days to 180 days. That's okay. And 13% are in 90 days. So let me say about 25% only, I think they are within the timeline. Now, even in liquidation, more than 2 years, 51%, more than 1 year, 24%, the timeline already overshoot. Then I will move to another important observation. I request all of you to pay attention on this graph. Now, the IBC was meant for both operational creditors, non-bankers, and financial creditors. Operational creditor, if there is a default of 1 crore and above, 1 lakh and above earlier, now 1 crore and above, they can approach NCLT under IBC. Financial creditors also can approach IBC under NCLT. Now, who has approached in more number? Who has approached in more number, whether bankers or operational creditors? Now, the figure very clearly reveals out of 5,000 odd cases, 2,699 cases filed by operational creditors only. Who are the operational creditors? Service providers, suppliers of raw material, suppliers of infrastructure like electricity, all other the suppliers except financial credit. The financial credit, only 2,236 people have gone. Now to conclude, number one, first conclusion, operational creditors made best use of IBC. Number two conclusion, more liquidation than resolution and restructuring happened during last 5 years. Then the real estate construction company are also facing lot of bankruptcy proceedings. Then deadline breach was there in many of the cases. Now, with my own experience, as I would like to make my own comments. Now, what is the actual cash recovery? The actual cash recovery in IBC cases, 2.5 lakh crore recovered. That means 33% of the total admit claim of 7.5 crore. Then, if you focus only on resolution part, only on resolved accounts, About 33% I told you recovered out of the total admitted case. So now what is my own observation? I want to make two observations. Observation one, IBC is a new baby and there were a lot of hiccups in the beginning, lot of problems, lot of cases, lot of stays, lot of counterclaims, lot of claims, lot of hurdles in implementing. So government went on as the government learned the experience, they went on amending the law. So it took some time to implement the IBC properly. Number two, what figure is not available with us is pre-IBC cases. Many and many, I think 3 times more than the recovery made in IBC were recovered just by sending a notice to the companies and LLPs that bank will approach the IBC. So this figure is not available with any one of us. Actually, this is the real figure. By threatening the tool of IBC, I have recovered many advances. As a GM recovery, I remember simply we went on all SMA2 and NP accounts. We issued a threatening notice that we will proceed with IBC. So many amount we recovered just prior to going to IBC, just by issuing a threatening letter. So this is my observation. Still, I say IBC is a most powerful tool, is as powerful tool as SARFAESI Act itself. So all companies, only thing is you can try only default is more than 1 crore. We can approach IBC only if default is more than 1 crore. That is the only point. Smaller value loans we cannot approach IBC. So I will move to the another aspect quickly. That is the MSME part. So this was introduced during April 2002, and this is a most powerful and very, very useful insolvency resolution process. And this is meant for only MSME. What is MSME? Maybe some people are not. If some people are not aware, I thought let me tell you. MSMEs, a unit is or enterprise is classified as MSME if the investment and investment in plant and machinery or equipment and turnover, the two criteria applied for an enterprise. If the investment and in plant and machinery or equipment does not exceed 1 crore, turnover does not exceed 5 crore, it is micro. If the investment does not exceed 10 crore, if the turnover does not exceed 50 crore, it is small enterprises. And if investment doesn't exceed 50 crore, if turnover doesn't exceed 250 crore, then it is classified as medium enterprise. So why I told this to you is that only these accounts are brought under pre-packed insolvency resolution for MSME, PPIRP process, only these accounts. So the MSMEs which are eligible to be classified as per the above norms that I have discussed, those accounts only you can take it under IBC. Now, please remember, if you are referring any MSME account, right now they should be either company or LLP. Non-companies, non-LLPs, you cannot push it to IBC. Please remember, any MSME you cannot push it under IBC. Only company the companies under MSME, LLPs under MSME, those companies only you can try under Insolvency and Bankruptcy Code. So here, the minimum default is 10 lakh, whereas in other cases it is 1 crore. Then he should be eligible to submit resolution plan. Then he has not undergone any pre-packed earlier 3 years. Then so these are all the eligibility criteria. Once he is eligible, then bank and the borrower, I'll say bank and the borrower. Bank alone cannot move under this. Please remember this. This one. So when the MSME company which wants to undergo insolvency resolution should have a certificate, that is Udyam registration certificate. Such MSMEs only are admitted under pre-packed insolvency resolution process. Then in pre-packed insolvency process also there are 2 phases. There is no liquidation. Please remember, there is no liquidation here. It is only resolution. Resolution will take 2 phases. Phase 1, pre-initiation phase. Phase 2, post-initiation phase. Now, what is done in pre-resolution phase? In pre-initiation phase, largely it is informal, and the post-initiation phase, it is formal, because in post-initiation phase, it gets admitted in NCLT. So there are 2 stages. Now what happens in pre-initiation stage? What is to be done? What is to be done in pre-initiation stages? Please remember, again, the initiation has to be done by the MSME borrower only. Please note this. He has to first seek the approval of creditor, the unrelated financial creditor, before approaching NCLT. Please note this. For approaching NCLT, a MSME borrower who is a company or LLP should seek approval of creditors, first thing. Then once he takes the approval of creditors, he has to prepare the application for moving to NCLT. Now there are so many small issues are there. I will not get into the details. Rather, let me explain like this only. See, when in pre-initiation stage, the MSME borrower, he prepares one small plan that is called base resolution plan, and he will go to his banker, that is unrelated financial creditors. He will go to bankers and take their approval. He will take their approval. Then he will also take a name of RP. Then he will also take a resolution of the company, resolution approving the starting of pre-packed insolvency resolution process. Then after getting all these things ready, this is called pre-initiation process, pre-initiation stage. So in this process, what is done is simply the MSME borrower prepares a base resolution plan for resolving the stress. He will discuss with the bankers, and he will take the approval of the bankers for proceeding with the PPIRP. Then he will move the NCLT. With all these things, he will move the NCLT. Now, if NCLT is satisfied, then it will approve the base resolution plan. This will be implemented. Okay, this is the flow of process. So, suppose the base resolution plan prepared by the MSME borrower, base resolution plan prepared by the MSME borrower is not in compliance with IBC norms, or it is not taking care of all the claims of financial creditor and operational creditors. The base resolution plan is not in tune with the IBC guidelines. It is not taking care of claims of operational creditors and financial creditors. Then the COC, Committee of Creditors, that is the unrelated financial creditors, they will reject the base resolution plan.
Okay, but sir, can we slightly?
Yeah, it is over. I'm ending. I'm ending.
Thank you, sir. Thank you. And just for discussion also, we'll keep some time.
Yeah.
It was a
So,
wonderful.
if just 1 minute, last sentence.
Yeah.
If base resolution plan is not approved, then they will call for the alternative resolution plan from the outsiders. They can, through a Swiss challenge process, the better plans are available. They will implement those plans. If plan is not approved, in any case, neither alternative plan nor the base resolution plan submitted by MSME, it will move into actual corporate insolvency resolution process. And I will end here. Now we will go for question and answer. Over to Ajayan.
Sir, thank you very much. It was a wonderful presentation by both the speakers. Lots of things to be discussed, and the forum is open. Participant, if you can, if you have something to discuss, or if you have to make some suggestions, you can do that. Or if you have some clarity, you have to bring on the points they have discussed. That all, this is an opportunity for you. And before we do that, let's have Sri Krishna sir, who is here. Can you have your words, sir, please?
Yeah.
Just we can then move fast.
Right.
Yeah.
I'm audible, sir. Good evening.
Yeah.
Respected Ajayan, sir, Principal SIBSTC, and Chairman SIBSTC, team members SIBSTC, and also the participants. Good evening to each and every one of you. Congratulations to Ajayan, sir, for having taken the initiative. And this particular series discussion we have been doing quite some time, that we wanted to have this type of programs. And I have been talking to Ajayan sir also off and on for this type of programs. And today, very glad that it has come out in a successful way. And friends, as we go along, there will be a lot of discussions on the varied topics which we propose to do in consultation with the SIBSTC and the VRDDHI team. So if you have any important suggestions to make where we can specifically give you the required topics, it will be given. And in addition to your JIB, CIB and other preparations, these type of extraordinary topics, contemporary topics will also help you to understand how to improve upon in our day-to-day process, etc. So let us go ahead.
Thank you, sir. Thank you very much.
Thank you.
I can see there are lots of very, very senior executives attending this sessions. Can you all come up with some inputs on the points they have discussed, and also on the SPV, what Mr. Rajkumar sir was discussing about the possibility of an SPV? How far it will be a successful initiative, and how we can improve this bankruptcy code and all that. If you can have a lively discussion on that, good. You can mute and talk, please. Anyone over there?
Yes,
Please.
sir. Again, sir, I am Mr. Rana.
Yeah, please tell me, sir.
Good evening. Respected Rao sir, Krishnadas sir, Rajkumar sir, and Bhat sir. Really, they have given an insight into these topics in detail. Basically, all of the candidates who were listening, I think it will be very much helpful for the institute to deliver to the candidates and those candidates who have listened to it. This is the present moment which we require in the banking industry. So I think it was one of the best initiatives, and we should hold on all these initiatives in future also. Thank you very much, sir.
Thank you.
Rajkumar sir, I have a small doubt. You are talking about an SPV. The SPV, since it becomes under SPV under the books of the main bank who is sponsoring the SPV, what will be the impact on the balance sheet? Will it be ring fenced from the balance sheet of the bank as such, which is what we are looking for? Because we are totally removing something from the bank and cleaning the bank balance sheet. And when you have an SPV, which is holding this, and what will be the impact of that?
It's a very good question. Though we have been talking about cleaning up of the balance sheet, even in Indian situation also we are talking about cleaning up of the balance sheet. That is happening only at the time of transferring the assets and receipt of the amount and the SR. Subsequently, when you have to make a provision based on the NAV or write-off after 8 years, it is a clear case that it is not resulting into cleaning up of the balance sheet. Same thing in SPV. It is a SPV. It is a holding company is transferring to there, but there is a definition there that further loss will not be there. See, they are already, in the case of SPV, 90% is transferred. It is transferred at 90% value. Realizable value is also found out. For the difference, their bank is already agreeing to pay in yearly installments. So that they have already identified what is the loss, and that loss is getting through a deferred payment. So part of your policy. Is it clear now?
Yeah. It's because it seems to be discussed.
German case, whatever loss is there, that is being by prescription of law, that is being paid over a 20-year period. So there is no additional burden is coming unless and until if the realization happens to be below the realizable value.
Okay, sir. Thank you.
Only in that case, there is an additional burden which will happen to the bank. To that extent, it is correct that it is not a 200% cleaning up. But in Indian situation, it is not at all cleaning up, though we are saying like that.
Okay.
Yeah, Mr.
100% right, Rajkumar sir, because sorry for interrupting. You can.
Yeah, no. My only question was to Rajkumar.
Yes.
If SPV is formed as a holding company, there is no arm's length between the sponsor and the holding company, in which case? So, because in the case of securitization of assets, what we do is SPV is an arm's length will be maintained, kind of mutual fund kind of structure, whereby when once you remove from the balance sheet of the sponsor, obviously they will have no hold over that. That is what like PTC or pay-through certificate or pass-through certificate you see in securitization. Whereas here, it's a holding company. So therefore, arm's length may not be there. That's what I just wanted to seek clarification.
That is true. In the case of SPV, that arm's length may not be there. I fully agree. But see the structure. See, there is no question of SPV or the government who is giving the guarantee incurring any loss. In that situation, even if it is not at arm's length, there is a question of that differentiation. If an SPV is likely to incur a loss, then what you are saying based on the definition, it is correct. But here, SPV is not going to incur any loss. Even government who is giving the guarantee, they have made it very clear that it is a subordinated guarantee that is there. And they have also made it very clear that in no case we will use taxpayers' money for the poor functioning of the bank. So ultimately, what we have to see is the structure is made. See, Indian banks are also suffering, German banks are also suffering. But the way the structure is made, it is the main issue here is the loss is being permitted to be paid over so many years. That special dispensation is to be considered by Indian government or RBI. Then much of the problems of the banks can be addressed, I feel.
Thank you. Thank you, sir.
And in our country, we have an experience. I would say that with IDBI, when IDBI converted itself into a universal bank from its development financial institution status, there was an SPV which was created, which was known as the Stressed Asset Stabilization Fund, SASF. And, at that point of time, I think probably the first such SPV in this respect, about 9,000 crores was moved from the balance sheet of IDBI, the erstwhile IDBI, to this as a fund. Looking back now, it is there on the public domain. The recovery has been only to the extent of 4,000 plus crores. So, what our Rajkumar sir mentioned, this is something which needs to be supported. This is not only for our country; every other country, I think, which has tested out this SPV route, they have been taking such hits. Only thing is, when these hits are taken over a stretched period of time, probably the impact will be less. So I think that is one evil which people will have to go through, even through the SPV route. So this, then one more example, I think there was another bank called Industrial Reconstruction Bank of India, which used to do similar work for rehabilitation or some. That bank itself became defunct in 2011 or 12, if I remember right. So these may be early experiences for our country. Maybe that is one route which can still be tried with a lot of support from people directly or indirectly involved.
Okay, sir. Thank you very much. We can take, it's already 9 o'clock. Maximum, we can take 1 or 2 questions if there are questions. Otherwise, we will stop this session.
I'm Gokul Raspai from Canara Bank. I've got one question to Mr. V.M. Bhat. This is on a practical side. I think Mr. V.M. must be having a very good experience as far as the IBCL recovery is concerned. My compliments to him. He made one point that even for one-day default, we can approach LCLT under this one IBC. Based on his experience, I wish to know what would be the approach. Maybe definitely it is on case by cases, but based on his experience, what should be the right time to approach NCLT or under IBC? Because whether we should try our all efforts before approaching to IBC. I just wanted to know, Mr. Bhat.
Thank you, Faisal, for complimenting. Now, my experience as well as my study on this aspect is that, see, in Indian situation, 30 days up to 60 days default is very normal, whether it is a big company, small company, whatever company may be. So, best time to approach is in SMA 2 level, because almost you are nearing the danger point. Or in many of the cases that I have filed as a general manager, we have only touched NPA accounts. We have not touched any SMA accounts at all, because there are so many accounts we had to go one by one. So mostly banks, go to IBC only on account slips to NPA. But ideal time would be SMA 2 or initial stage of NPA level, initial stages. Have I answered
Thank you.
question, Paisa?
Yes, yes, sir. Yes, yes. Thank you. Thank you very much. Thank you.
Any more questions? There's time for one more question.
Sir, in total, how many days it will take, sir, to complete the process?
There are two issues, please remember. I have covered two topics. One is corporate insolvency resolution process, CIRP. That is for companies, big companies. Now for their normal timeline given is 180 days. It can be extended by another 90 days, 270 days. Suppose a case gets into litigation. Suppose somebody goes to court, then maximum timeline available is 330 days. 330 days. Within 330 days, resolution should happen. Resolution means resolution of stress in the account. Now, suppose 330 days, the resolution doesn't happen, then it will move to liquidation. For liquidation, 24 months. Now, as regarding MSME, pre-packed MSME is concerned, this timeline is not available. This timeline is not available. So, maximum time for resolution. There are only resolution. There is no liquidation in MSME pre-packed. Resolution is 120 days. 120 days. Within 120 days, whole implementation of resolution plan, base resolution plan or alternative resolution plan should be implemented. Otherwise, it will move to CIRP. It will not move to liquidation. Please remember, it will move to CIRP. That is corporate insolvency resolution process.
Okay, thank you, sir. Thank you very much. It was a very,
sir,
very...
one more. I am Rajkumar here. I am having one more question to Bhat sir.
Yes, sir.
Please.
See, you have said that there is a timeline of 6 months, 290, 180 days, 270 days, and up to 330 days or something, where the cases are referred to the court.
Yeah.
But is it not visible that the courts are taking so much time for taking decisions? In some cases like SR, Steel and all that, they went in appeal and it has gone up to High Court, Supreme Court. Is it not taking too much of time beyond this 330 days? In that case, what will be the...
anything beyond 330 days is with the approval of court. Please remember. It will be with the approval of court. If court will be knowing that this case passed 330 days timeline. So that is why 330 days is not mandatory. It is directionary. That is why when government passed the law that maximum time available is 330 days, Supreme Court said you cannot make it mandatory because there may be some issues that is to be looked into by the courts. So directionary timeline is 330 days.
Okay.
But with the knowledge of the court, it can go beyond. You can see the picture I have posed before you.
That means
66%. Yeah.
Court can consider that there is a delay beyond the control of
Yes.
the...
Yes.
Okay, thank you.
Yeah.
Thank you, sir.
One doubt, sir.
Yeah.
Yes, please.
Sir, this prepackaged insolvency resolution plan, it is 120 days maximum.
Yeah.
And there is no liquidation.
Yeah.
It has to go to CIRP again.
Correct.
Whether again this 180 plus 90 plus 60 days, that is available again.
There will be another. Yes, sir. Another process.
Over. 120 already over. 120 days already over.
120 over. There will be another process called CIRP.
Then 180 days again available there.
Yeah. 180 days available. There, please remember, MSME borrower cannot participate. There, they will invite public people for giving resolution plan. He has limited role. So there is another process itself, 180 days plus 90 days, 330 days.
Okay, thank you, sir.
Thank you very much. So there has been very vibrant presentations and very vibrant discussions, sir. And I will just conclude with one.
Mr. Ajay, before concluding, just one sentence. In fact, our chairman just now telephoned and complimented for the wonderful things that we have done.
Yes,
and he suggested to me that every month, last Sunday, last Sunday of every month, a seminar on contemporary topics can be conducted.
Very well, very well. We will do that.
We'll make an announcement last Sunday of every month
between
7 p.m. to 8 p.m. Maximum 1 hour.
1 hour, 1 hour, one topic.
And also, and we'll restrict to one topic with a huge discussion so that it is not too much boring for the participants also, and then testing their patience and time on Sunday evening.
Yes, sir. Yes, sir.
So what I request through this is we will have it on last Sunday of every month between 7 p.m. to 8 p.m. And confine it to one contemporary banking, finance or economics related topic.
Definitely.
A speaker should be a renowned person. We'll do like this.
We'll definitely do like that only. So thank you for valuable words and suggestions. The participants also can suggest any topic. Either you can send it to SBSTC, Rao Saji, or you can even mail to us also. We will just sit and decide and do that. Okay.
Yes, sir.
So one more thing, can I, but sir, before we conclude, since you were talking about so much of statistics, I'm interested to know where the resolution was possible, where there were actually, what was the strength of those companies, were they originally diverting the existing funds, or what was the character of that default?
No. They were all 20%, please. 20% of the companies only found resolution.
Okay.
Not all. See, 47% went into liquidation.
Even 20, what was the source for them?
20% were not involved in any diversion, any out of the issue, any fraud, nothing.
Okay.
That is why these companies were viable. There were temporary problems, demand issues like that.
So
that is why they could have a smooth resolution.
Or some kind of hand-holding by way of equity or some companies into this to... No. No, because were they able to bring in some other partner to with funds to resolve this?
Sir, there were many sales that have occurred.
Okay.
Say sales Ruchi to Patanjali.
Okay.
Steel to Tata.
Right.
They have purchased because these companies were viable.
Okay, good.
See, Ruchi was purchased because this company was viable. Tata purchased Bhushan Steel because that was viable.
So there is a final word.
That is viable at a lower price.
Let us not debate over that.
Okay. So we have a suggestion from William Raju, which has come in the chat box. We'll bring that suggestion for everybody to think over. The bank which appraise the credit and monitor it is best place to recovery of the amount than ARC or bad bank. The government RBI should provide infrastructure for recovery of loans by the banks themselves, but should not guarantee the SRs. Okay, if the bank could not appraise, monitor, and recover, then why they are lending? Is there any change? Is there any changing role of the banks? Please comment.
Is the question, the suggestion which has come?
This is an opinion that has come.
Okay, very good, very good.
We can debate for another 2 hours.
We can debate for another 2 hours. Thank you very much.
He is the retired General Manager of Reserve Bank of India.
Great, sir. Great. William, sir, thank you very much for bringing something that let the bankers...
I would like to some 2-3 points on this. I'll close it. I'm William Raju.
Yeah, please.
You see, generally, while appraising the loan and making the installments, banks are blindly following monthly based installment without looking into the cash flows of the banks. That lead to the delay in payment and this resolution concept. The moment the bank is going, the borrower unit is sent for resolution, its price in the market will be slashed to 50 to 60%. In fact, by my simple question is, by faulty appraisal of the loans in the form of the assessing the real cash, but the cash flows, banks are killing the viable units.
So,
please comment on this.
So there are lots of bankers, sir. It will take another 2 hours go on discussion. The points are well taken. Everybody can think over it. And William Raju, sir, we would like you to be there in all our panel discussions and bring forth such points. At least
in one sentence, sir, I can answer that. Sir, cash flow statement and project profit and loss account, all these things are provided by the borrower, and it is prepared by a chartered accountant, beautifully presented. And bankers,
sir, that
definitely
never takes away the role of appraisal. Because somebody is presented, that never takes away the role of the appraiser. He has to see the trends in the cash flows. Actually, I'm telling you, because most of the borrowers suffered. We have seen both the bankers' appraisal and as well as the borrower side also. Most of the borrowers suffered because of these rules. Because they do not have the monthly, blindly they are giving the monthly installments. But his cash flows are erratic. We do not have a system of means proper cash flows. Cash flows are erratic, and we should project the installments or decide the installment based on the cash flow. That is the crux of the issue. And you are selling the unit. People are waiting to purchase it at 50 to 60% discount. You are means killing by giving loan. You are killing the good units also.
Okay, sir.
That's the question of. Actually, borrowers are crying. In fact, I'm telling you.
Okay, thank you, sir. Thank you very much. Lots of thought, lots of things for thought. Tomorrow and day after, bankers can think over this, and when the next proposal comes, they can also will get an insight into it. Mr. Rao, sir, can we conclude, sir?
Sir, please, sir, conclude, sir.
This was a wonderful day with lots of takeaways for the participants, lots of interactive discussions. May I request Dr. Lalitha Menon to propose vote of thanks and conclude the session. Thank you very much.
Thank you. So we come to the end of a very lively session on banking. And I think the last couple of hours, you've given a lot of serious thought to some pertinent aspects of banking. Now I have a few people to really thank, starting with Mr. Mahabaleshwar, MD and CEO of Karnataka Bank, Chairman of SIBSTC, for flagging off the event.
Thank you, madam. Thank you very much. Well done.
For flagging off the webinar with very good words of good wishes. Followed by Mr. KSLN Rao for not only inaugurating this session, but for paving the way for a very bright future for such collaborative efforts. Mr. Krishnadas, thank you for the comprehensive presentation of the theme. Thank you, Mr. Rajkumar and Mr. Vinayak Bhat, for your very insightful keynote addresses. And to Mr. Sri Krishnan, who stepped in to say a few kind words, and to all the remarkable participants on the gallery who contributed to the vibrancy of the whole program, and with their very strong presence elevated the webinar to full house status. And some of you stayed on for a very long time. Looks like that this is the beginning of a very purposeful partnership in disseminating information and knowledge and updating banking personnel with all the latest developments in the field. Thank you very much for this wonderful evening. Thank you all.
Thank you.
Thank you. Good night.
Thank you.
Good night.
Thank you very much.
Thank you very much. Good night.
Okay. Thank you. Good night.
Mahabaleshwar sir, thank you very much for your suggestions. We'll take it forward. Rao sir also. Right.
Thank you.